I'm Alex Mozet, and welcome to Winner Take All, where we talk about the constant battle between large tech monopolies and traditional incumbents. We're going to get to the Tidal situation, Square situation in a second here. But just to start off with some other madness, which also doesn't make any sense, is, Google has come out because Apple's put into effect more privacy standards to prevent, egregious tracking outside of apps, right? So Google and Facebook have historically been able to track what you do, and other companies track what you do when you're not even using those apps. That's how, when you're just talking about something and then you see an ad for it in Google or Facebook, they're listening to you, they're tracking you when you leave the app, everything and everywhere you go on the internet, irrespective of whether or not you're actually doing it in one of their products. So Apple said, hey, we're clamping down on this. And then Google said, okay, great. Yeah, no, we are going to, we're going to police ourselves because as Engadget says, Google is policing itself on privacy because it knows it has to. Who believes that Google is really going to police itself? What this article goes on to tell you is that Google's going to shut down third-party cookies. Despite that, yesterday's news that Google will not build identifiers to track individuals across the internet came as a surprise. The company also affirmed that it won't use any new identifiers made by third parties. So if Google's whole business is selling ads, and the way they sell more ads is by having more detailed information on what you do on the internet, so they can serve you better ads, and then they can make more money. How could any of this make any sense? Well, the answer is Google has figured out how to track you using alternative means. So they're not hurting their business. Just because Apple's changing iOS and preventing this tracking doesn't mean that Google said, whoa, we have to wholesale change our whole business model. We're going to hurt our ability to operate in our cash cow monopoly that is search and our advertising duopoly with Facebook. Nope, that's not what they're doing. This is really just a PR stunt. And Ben Thompson does a pretty good job of explaining what Google is doing to basically get around this. So here, if you can see here, Paul Graham's reaction. What this news tells me is that Google has found a way to target ads just as effectively without using the data that they're saying they're going to stop using. Ben's response is, you would be right. And so basically, if it doesn't make sense, you're right. It doesn't make sense. Google's not actually getting out of the tracking business. They've just figured out a way to do this and have been working on it for a long time. They've just figured out a way to do this in a different way with different technologies and different data, because Google has over 50% of the digital advertising market. So they're just pinpointing this on kind of technologies and data protection rights that have been in the news for years. Google's moved past that effectively. There's no really material change to Google. I think it's just more of a PR stunt and to try and make themselves look good. It doesn't make sense, and there's a reason, because Google's not actually changing at all. Another deal that doesn't make sense is Square buying Tidal. Can't even keep a straight face talking about this. Just announced, Square buys majority of Tidal, adds Jay-Z to its board in bid to shake up the artist economy. When you look at the numbers, the deal is worth $300 million. They're valuing Tidal no more than $600 million. I don't think we know the exact valuation, but they have a majority stake. The other artists that were also shareholders in Tidal also get to effectively roll their equity, so they're still on the cap table. This is let's call it a sub $600 million business that is now competing against Spotify. Spotify is a $53 billion business. I wouldn't be concerned. Their stock's down. I wouldn't be concerned by this news one iota if I'm Spotify. You got a $600 million business against a $53 billion business. Oh, and I forgot, there is actually one other player in the music streaming business, small company, you may not have heard of it, called Apple. It's not even a platform business. Spotify, we've talked about, not a platform business. Tidal, definitely not a platform business. the music rights, the music licensing industry is basically controlled by the four giant, publishing houses. And then they've actually aggregated all their supply through the RIAA, like the Recording Industry something association. And that organization basically negotiates licensing deals with Spotify and others on behalf of just about the entire music industry. So you can imagine the pricing power and the leverage that, the RIAA and then the different recording, publishing houses have, because they basically just all joined together into one negotiating house. For that reason, the supply is not fragmented in the music industry. That's why we've seen Spotify making huge investments with podcasting, because that is wildly fragmented. There's a myriad of creators, much of them independent. And so, Spotify, we've really liked this approach for them to go after podcasting because it has legitimate platform dynamics where traditional music does not, right? It's much more of a linear digital business, which means that for Tidal to come from way far behind and try to catch up here, it just doesn't make any sense. Maybe the board justified this because if you look at the money that Square made on their Caviar investment, they bought Caviar for $100 million. They sold them to DoorDash for $400 million, $300 million. Maybe Jack Dorsey, who's the CEO of Twitter and Square, maybe he was like, yeah, just take the $300 million that we got from selling Caviar and let me go do this other Hail Mary bet in Tidal. Maybe that's how he justified it. If I'm on the board of directors, I would not be proud about this decision at all. So let's look at who's on the board of directors. Okay, there's Jack. You got a couple VCs here. Okay, Roloff, this guy's legit. You got Mary Meeker. She knows what she's doing. Anna Patterson, not as familiar with her, but you also have Larry Summers. This guy said that there's no threat from China when it comes to Chinese tech monopolies, Huawei, and the like. He just hadn't seen any evidence of it. Okay, Larry. All right. And you got the chief innovation officer at the NBA. You got this guy from the Ford Foundation. I don't know. The board failed. The board, if anyone's supposed to keep the CEO in check, it's the board. And this is a fail. I would imagine that the really astute technology investors and operators like Mary and Roloff here could not really be backing this. I would imagine that, maybe Jack got some of these other board members to be for this, but the real serious technology operators there would not approve of this. So, what is some of the reaction on this? Even this, my group here, The Information, which I don't tend to see eye to eye on very often, even they're knocking this transaction. Even if it was a successful music streaming company, Tidal isn't a good fit for Square, which has steadily expanded the financial products it offers, most recently by launching a bank. On Twitter, Dorsey said the deal would help Square create new tools for artists, included by creating new listening experiences to bring fans closer together, as well as merchandising integrations and new revenue streams. I mean, the guy's in outer space. In reality, Dorsey is trying to jam a square peg into a round hole. It may be time for someone else at Square to grab the wheel. Board, wake up, board of Square. This is not only is the money, the money is not too significant, right, from what I was talking about with the Caviar earnings, but it just goes to show you, what is management really focusing on? You can see here, Square down 9%. It should be more. You got almost $100 billion market cap here. Who cares about Tidal? And then you're going to put Jay-Z on the board? Why is Jay-Z going on the board of Square? The Google thing doesn't make any sense because it's fake news. That's a PR thing. Google's not dumb. They know what they're doing. They're not hurting their business. That's just a PR distraction. This deal, though, this is just straight dumb. Who does this? What a waste of time. This guy's operating two businesses. And for the one half of his time spent on Square, he focuses on the Tidal transaction. I mean, I've got let me show one. I try not to do this. It's just too tempting. Here's the fearless leader. This is the guy. The astute and sound and, very focused, sophisticated CEO of two publicly traded companies, Square and Twitter. This is the guy. This is the fearless leader. This guy's a joke. I cannot believe it. All right. Yep. Can't make it up. In other news, fashion marketplaces are, really coming into their own. We've talked a lot about Farfetch, the number one leader. We've seen, the whole ethos of winner take all. The show is, right, how these two worlds, tech monopolies and incumbents, are battling it out, and how can we bring more parity to the extremely kind of unbalanced nature of tech monopolies in today's environment. And so what we've started to see in luxury and in fashion is we've seen some of the manufacturers wake up and say, hey, marketplaces are kind of a big deal, kind of like the next big distribution channel for us. I should have a stake in that next big distribution channel called Marketplace. We saw Richemont, which owns a bunch of different luxury brands, put a bunch of money into Farfetch. They launched a JV with Farfetch in China. Richemont sells a lot of jewelry, a lot of luxury goods in China. And then also, put money into Farfetch, holding Farfetch proper. We've also seen the Kering Group, which owns a number of other luxury brands like Balenciaga and others. They had put money into First Dibs years ago. First Dibs is like the number 3 trailing sneaker marketplace. But then recently, Kering put money into GOAT, the number 2 sneaker marketplace that Foot Locker had put money into a few years ago. And we've also now seen Kering put money into a company called Vestiaire. So, we've talked a lot about these kind of luxury goods marketplaces, Farfetch, The Real, I'm going to come to them in a second. You've got the sneaker marketplaces, you've got watch marketplaces, and now you have, and not now, but you also have secondhand clothing textile marketplaces. These aren't as much around luxury. Poshmark recently IPO'd. I think their average sale price is like anywhere from $20 to $30, right? It's a very different price point of consumer. Vestiaire is a competitor to them in Europe. Vestiaire Collective here raising $216 million for its secondhand fashion platform. The company raised $216 million and has reached unicorn status at over $1 billion valuation. Now, the interesting thing with this here is that Kering Group has taken a sizable stake in Vestiaire. Kering is leading the round along with Tiger Global. Kering now owns a 5% stake of Vestiaire. So simple math, that means these guys wrote a $50 million check into Vestiaire. So they're doing a lot of deals here, right? They are, aggressively pursuing marketplaces. That's clear. And they're actually operating in a lead role, right? They're actually saying, yes, Tiger, let's co-lead this round with you, as opposed to being a follower on the round, right? These guys are really leaning in and saying, we need to put dollars to work in marketplace. Not only do we need to control the distribution channel, but this is also a defensive move in a couple ways. One, what you don't want to have happen is what just happened to the banks with Plaid. So we saw Plaid work with 200 plus banks, that interconnected infrastructure, right? That all the banks are connecting to, all this data going through Plaid. Visa tries to buy Plaid for $5 billion. The banks hadn't taken a position in Plaid. Visa's a platform company. Actually, platform monopoly status, one of the oldest platforms actually, and obviously in Plaid. Great decision by Visa to buy Plaid. Because none of the banks put enough money into Plaid as an investor, they didn't have any rights as a defensive mechanism to say, yeah, Plaid, I want you to be successful. I want you to grow. I want to use your service because you're great. But I don't want a tech monopoly to buy you. That could include Visa, MasterCard, but also obviously a Google, Apple, Amazon, etc. That I think is another key part. Not only can incumbents, by investing in up and coming dominant platform businesses, use that to their advantage for revenue synergies, for other strategic synergies, but it's also a defensive mechanism to protect against the scenario where, in this case for Vestiaire, if Amazon says, yeah, Amazon luxury just isn't working out as well as we had thought, or if Amazon says, I want to get into secondhand clothing, let me go buy Vestiaire in Europe, right? Now you've got some downside protection, because what would be even worse is for these large tech monopolies where doing $1 billion acquisition is literally just a rounding error to them at this point. Now you've got some protection against that. So it's another reason why I really like to look at what's going on in fashion as an example for what I think we're going to start to see in many other industries and verticals, right? Incumbents, up and coming tech startups coming together, sharing synergies, both having revenue lift and putting capital to work in the startup business, because you can make good money on your investment, but you can also get some rights to protect against those adverse scenarios where that large tech monopoly comes in to just buy that dominant platform in a given vertical. That's basically the key growth strategy of these tech monopolies, right? Everyone complains about Facebook buying Instagram. It's the same thing, right? They just come in, they buy a business for a few $1 billion. That's the growth mechanism. That's really how you see tech monopolies at that platform conglomerate status roll into new adjacent platform businesses. It's not really a build from scratch strategy for the tech monopolies. They're too big. They really can't go build new businesses from scratch. It's so hard to do. So hard to do in general, let alone with all the inertia and all the other stuff going on inside of these big companies. M&A is really the key way that these tech monopolies expand into other verticals. So by investing in a Vestiaire, you're just taking another chip off the table that a tech monopoly can use to roll into these types of industries. So Vestiaire is a leading player. The other one in Europe is called Vinted. Vinted and Vestiaire are really the two top players there. In the US, then you really have Poshmark and ThredUp in this kind of secondhand fashion, retail environment. Very interesting space. The interesting news on Farfetch and The RealReal is you're also now starting to see that winner-take-all dynamic in luxury goods. So different than the secondhand space that I'm talking about here. Farfetch came out with their earnings here. Farfetch reaches profitability after 12 years. I mean, that's kind of what it takes, right? You have aggressive growth. You're reinvesting in growth. The luxury e-commerce platform's revenues in 2020 increased 64%. $1.7 billion. They've done a lot of really interesting things. Again, platforms don't have to, they're not mutually exclusive. You can have platform revenue and you can have linear revenue. Farfetch has acquired key brands like Off-White brand, which I think was the former designer from Louis Vuitton, I think. So, they have their own proprietary brands that Farfetch is controlling. And obviously they have the marketplace dynamic, but revenue rose 64% with gross merchandise value exceeding $3 billion, up about 49% year over year. Their revenues are actually growing faster than the GMV, which means I think that speaks to this hybrid, right? Linear and marketplace dynamic. Where you're grabbing more revenue by selling more products in a linear kind of reseller from balance sheet model. What this graph is showing is that for manufacturers, this is a graph to woo manufacturers. This is also kind of this is really kind of the marketplace end state is you use third-party stores and sellers to get traction. That's actually what helped Farfetch get a lot of that initial traction is they went to these boutique retailers and helped attract the boutique retailers to sell. What this graph is showing This is a graph to woo manufacturers. We've seen Amazon do this, right? Where they woo the third-party sellers, the distributors, the retailers to come sell. But they're the intermediary step for the marketplace to then cut out that middleman. I know it's a taboo word, and then go to the actual manufacturer. That's kind of the marketplace playbook many times. Not all the time, but many times. So what this is saying is, hey, on the left, hey, manufacturers, if you go and you sell your products to wholesalers and distributors, right, and it goes to the traditional retail channel, look at how much margin you're losing. But if you go through the far-fetched channel, right, brand revenue, see here, they've got brand revenue in the lighter shades of blue. You will keep more of your margin because what are you doing? You're cutting out the intermediary, either a distributor, a retailer, variety of different folks that are buying and reselling those goods from the manufacturer. So you can see them, they've reached the stage, right, where they're now trying to go directly to the manufacturer. It's a critical kind of evolution in the business. On the other hand, though, RealReal struggling. RealReal is a much smaller US-based far-fetched luxury good competitor. They actually had a decline in Q4. Basically, what you're seeing with RealReal is you're starting to see the discrepancy between the number one and the number two player. Here's RealReal, not doing so hot. So they're a much smaller number two than Farfetch. Last topic. So I was talking about Coinbase's S1, and Coinbase on the secondary markets was selling its shares for roughly $100 billion valuation at a little bit more than $1 billion in revenue. And they made a few $100 million in profit. Very nice, healthy margin business. But the thing that I was really looking for in their S1 was Coinbase has been more bullish on crypto than anyone. I mean, it's their whole business, crypto. So you would think that there was other stuff on the balance sheet that would justify a 100x revenue multiple. If we look at page F31, all the way at the bottom of the S1, it says that as of December 2019, Coinbase was holding about $34 million in crypto. And as of December of 2020, they were holding $316 million of crypto. So it went up a little less than 10x. On page 100, they describe what they're holding. So as of December 31st, 2019, Bitcoin, Ethereum, and Tezos represented 44, 12, and 16% of the total crypto assets held. So that was as of December 2019. As of December 31st, 2020, Bitcoin and Ethereum represented 63 and 8%. And we don't know what makes up the other 29%. So they went even heavier on Bitcoin, actually trimmed back on Ethereum, and then they started to hold presumably even more altcoins than they had been prior. So that's interesting. Here's another good nugget. Our crypto assets held are accounted for as intangible assets with indefinite useful lives and are initially measured at cost. Impairment exists when the carrying amount exceeds its fair value, which is measured using the quoted price of the crypto asset at the time its fair value is being measured. We assign cost of transactions on a first in, first out basis. So this is talking about how they value the crypto, right? Because if you spent $33 million on Bitcoin 7 years ago, very different story than spending $33 million on crypto in 2019. You'd still be doing pretty well right now, but also very different ways to think about how you value that asset. Suffice to say, it's actually a little none too inspiring. I would have thought that these guys would have had $50 million in crypto that they've tucked away over the past 8 years, and that thing is now worth, billion, I don't know. What would it be worth now? Like $10-20 billion. And then you'd say, oh, okay, $100 billion sale on the secondary markets for their shares. That's the kind of the effective valuation they got. Okay, yeah, I think they did $1.3 billion in revenue, $100 billion valuation. again, I'm not saying the numbers make sense, but it would at least help fill in some of the gaps. What are some comps to Coinbase? I mean, it's hard, but you could actually look at Robinhood's not public, but the role of Robinhood as a retail trading app for stocks is actually very similar to Coinbase. Just you're trading different stuff. One is stocks, one is crypto. Now, a public company, which actually is much more robust, has a variety of different revenue streams, but also helps traders, both institutional and some retail, trade and has been around forever, is Interactive Brokers. Interactive Brokers has a $32 billion valuation. They got a 30 PE ratio. They're doing about $2 to $2.5 billion in revenue, and they've got a $32 billion valuation. So very nice multiple. Let's call it roughly 15x revenue. You got a 30x PE ratio here, price to earnings ratio, and then you do the math, and you just think about the back of the hand napkin math on Coinbase. They would have roughly a 300 PE multiple if we took the valuation that they had in the secondary markets. And that's where I thought maybe if they had just a boatload of Bitcoin sitting in some USB drive somewhere, that would help fill the gap for me, because I just wasn't seeing it. And I just still don't see it. I mean, it's an awesome business. They've done a great job. It's not a platform business, just like Robinhood isn't a platform business, just like Interactive Brokers isn't a platform business. Why Interactive Brokers is not in Plaid. They're not actually an investment platform. Whereas the NASDAQ, whereas ICE, which owns the New York Stock Exchange, they are in Plaid. It just, it's just not adding up. I mean, there's a lot of things that aren't adding up, but this one's not adding up in a very big way. We'll see where the pricing actually comes out when the shares go public. Not to say that they would go at $100 billion. Not sure who on the secondary market said, yeah, let me buy these at $100 billion valuation. But yeah, I guess, crazier things have happened. Just not for me. That's it for us today on Winner Take All. Thanks very much for joining. I'll talk to you soon.